So this is session 3, I want to say, of the semester.
Yes.
Is that right?
Yep.
Okay. Ethan, in the meantime, will you just keep letting people in as I'm speaking just for a minute?
Sure, no worries.
All right, perfect. So yeah, just before we get started with the actual session, well, firstly, hi everyone. We've had a lot of questions regarding the fundraiser that we're taking part in called Fight 2021. So I'm very, very briefly going to explain what it is, why it matters, and why we need all of you guys to get involved. So effectively, Fight 2021 is an alliance of 60 other societies very similar to ours around the country. I came up with the initiative because student mental health is at an all-time low. I think the stat is that 27% of students have reported a mental health problem in the last year. If we take that statistic and literally apply it to this room right now, that's about 12 of us could be suffering in silence. So over the first 2 weeks of March, i.e. starting next Monday, hundreds of students, professionals, alumni, etc. We're going to be running, walking and cycling 10,000 kilometers to raise at least £10,000 for Mind, the mental health charity. We need all you guys to get involved, not only because it was my idea, but because we want to show our solidarity with those that are struggling and show that we're a generous society and a generous community, which I know we are. So if you want to walk, run or cycle, no matter how far, please sign up using the link that I'm about to put in the chat right now. You can find a bit more information on that website as well, fight2021.com. And what else? Yeah, if you're happy to donate, there's another link which I'm going to send out later. Even if it's £5-10, any amount, we would be extremely grateful for. We're already about 40% of our total target, so any help is incredibly appreciated. And you can get your friends, family, housemates, course mates involved too. They don't need to be a member of our society to run. So if you don't want to go out walking in Selly or the Vale alone, go get your housemates to run with us and sign up all together. So without further ado, let me pass on to Henry, who's about to blow your minds with an incredible session on valuation. So Henry, take it away.
Thanks very much for that, David. Good evening, everybody. And well, just firstly, again, congratulations on getting the Fight initiative off to such a great start, David. I know how well that's been going, and we're all excited to be running for charity in the near future. Again, great to see so many people here tonight. Yeah, it's lovely. It's great to see so many people still coming into the chat as well. Right, so session 8. Is my screen showing up all right, David?
Yep, yeah, can see it.
Perfect, I will get in. Okay, so disclaimer as always, don't need to go through that. Anybody here who hasn't come to a session before? Is there anybody new? Anthony's not new. Anthony.
That was a mistake. I've been here before.
Yeah, no worries, mate. Right, so I'll get started then. So what we're talking about today? So effectively, we're going to go through value investing. We've been through a lot of different types of investing, and maybe in hindsight, I should have done the session even earlier. But this has kind of been my roots as an investor. I think it's a very useful way to invest your money. It's very, very practical. So we're going to go through that. We're going to go through some key pros and cons of using value investing as a strategy. And then we're kind of going to discuss the different types of value investing. And whilst putting this presentation together, I realized that there was a lot of content in there. So this is going to be probably quite a few sessions, but we'll see how we go tonight. But certainly in the future, we'll be delving into these topics in a lot more detail. Another reason being is that David said a lot of people have been saying that sometimes the content will get quite advanced. So what I'm going to do is I'm going to skip this a little bit more back to basics so that everyone's up to the same speed, and we'll get on to the more complex things in later sessions. But for now, it is just kind of this general overview of value investing, what it is, how we can use it, and we'll get into some specific concepts a little bit later on. Books to win tonight. For anybody who doesn't know, we always give away a book at the end of every session. And was putting this together, I just thought it had to be The Intelligent Investor by Benjamin Graham. I think it was 1949 it's come out, but it certainly stood the test of time. It's been around, what would that be, 72 years. And it has been, yeah, it's an incredible book. It's quite heavy. So this is why there's an alternative tonight. There's The Intelligent Investor 100-page summary by Preston Pish and Stig Brodersen. So basically, Ethan will tally up everyone who's here tonight. You get a free shot at winning one of those 2 books. Just let us know if you would like the full comprehensive Benjamin Graham, or if you're a bit newer to investing, I'd really recommend the summary. But even if you don't win, I'll thoroughly recommend them. They're great books, amazing value for money. Yeah, and that's basically it. So we have YouTube channels as well. I appreciate that sometimes a lot of what you hear tonight, you might want to go over again. So we basically upload these sessions to YouTube afterwards on a University of Birmingham Society investment channel. We've got all the videos in the series going back there, and this will be uploaded tonight if anybody wants to go through anything. I've also got my own YouTube channel up and running, which I'll be talking about later in the session. But for now, let's get on with talking about value investing. Okay, so what is value investing? For me, it's very much my home ground. Like, I've played around with a lot of different types of investing, but value investing is my roots, so to speak. It's kind of where my forte is at in terms of my knowledge in investing. So it's very, very simple. And this is why I love it. Like, it's not a difficult concept to understand. Value investing is basically where you buy a business where it's cheap. You work out a business as cheap or expensive. You buy the business when it's cheap, and you sell the business when it's expensive. And that's basically the whole point of value investing. You know, you have a stock, you think the stock is worth $40 a share, you go and you buy it for 20, and it goes above 40, and you sell it. That is basically the basis of value investing. Yeah, it's literally that simple. So where did this whole idea come from? I thought it would always be good to, when you explore these concepts, kind of take them back to their roots and see kind of how they've evolved over time. This is Benjamin Graham. He's the chap who wrote the book, The Intelligent Investor, which is on our giveaway list tonight. So he is what is called the father of value investing. And there are a lot of people that really look up to him in terms of his investment skill set, his investment knowledge, but most importantly, his investment philosophy. That's what value investing is really. It's a philosophy. It's a mixture of art and science combined together to kind of make this general investment strategy. So he summed this up really nicely in a quote, which I'll read out to you, which, yeah, I think it really summarizes the value investing well. So he said, buy when most people, including experts, are pessimistic, and sell when they're actively optimistic. The market is a pendulum that forever swings between unsustainable optimism, which obviously makes stocks too expensive, and unjustified pessimism, which makes stocks cheap. And the intelligent investor is a realist who sells to these optimists and buys from these pessimists. So effectively, what is the idea here? So basically what Benjamin Graham is saying in this statement is that he's saying the markets will tend to overreact to optimistic news, and they will tend to also overreact to pessimistic news, right? And what this will do is it will create distortions in the share price away from kind of the true value of the business. If you can work out the true value of the business, and then you can just compare that to where the price is, when the price is distorted, you can take advantage of this by buying the business when it's cheap, selling the business when it's expensive, and then making money off that capital gain. So that's basically the whole idea behind value investing. Does anybody have any questions thus far?
If you do, just feel free to pop one in the chat or turn on your mic and we can get it to Henry. I think Warren Buffett, you might have this quote already in your presentation somewhere, but I think he summed that up very well, didn't he, when he said, be fearful when others are greedy and greedy when others are fearful. So
exactly.
Yeah.
Exactly. Yeah, I mean, and he's certainly doing that at the moment. You know, he's basically saying, like, there's not that much to buy. That's what he's been saying for a long, long time, is that he's struggled to buy a lot of investments because the market has been pretty greedy, if I'm honest with you. We're way above pre-corona highs in America in particular. But fundamentally, look what's happened to the economy. Look, I don't want to get into macroeconomic discussion, but Warren Buffett is certainly using that quote to kind of reinforce his investment philosophy at the moment. Yeah, with regards to questions, I will stop and I will pause kind of every 3 or 4 slides. If you have a question, very welcome to put it in the chat. You can even say I have a question and then kind of turn your mic on, but no pressure either way. Just do whatever's best for you. Okay, so yeah, oranges of value investing. Here we go. So Benjamin Graham, as I said, very kind of famous investor. He wrote these 2 books. Security Analysis is the other one that's kind of even heavier and more comprehensive than The Intelligent Investor. I would say that these are more like manuals rather than like a read to cover book. Like, it's very difficult to read The Intelligent Investor cover to cover. It's very dense and very old. But where it is particularly useful is just like, if you're thinking about investing, you pick it up, you go to a particular chapter that's kind of relevant to what you're currently thinking about. That's where these books are really, really useful. And it's incredibly widely followed by these very, very legendary investors. There are absolutely loads of them. Like, I could have put like 100 people up on the screen who kind of all cite Benjamin Graham as a massive role model in value investing. But Warren Buffett, he actually studied this course under Benjamin Graham at Columbia Business School. I believe it was just called Value Investing. And he kind of became a disciple for Benjamin Graham. And Warren Buffett, again, a legendary investor. He was the richest man in the world for much of the 90s and the 2000s, particularly after .com hit, and has done an incredible job with investing. So for people like Warren Buffett to be saying Benjamin Graham is his idol, Benjamin Graham, who is the father of value investing, is certainly worth paying attention to, and hence value investing is also worth paying attention to. We've got Irvin Khan here as well. He's a very famous investor. In fact, fun little fact about him, he was still working on Wall Street when he was past 100. There's a video clip of him. You can see him. He's 106, and he's still working on Wall Street. And his family broke the world record for like the oldest surviving 4 children. They all lived like way above 100. And he still cited Benjamin Graham as one of his top idols. Preston Pysh as well, the guy who wrote the book summary. He's a massive fan of Benjamin Graham, and also somebody that I highly respect in the investing world. Okay, so what can we learn from Benjamin Graham first? I thought I would mention that Warren Buffett, he loves Benjamin Graham. That's all great. He sees him as a disciple. But what can we really take from Benjamin Graham that is the most kind of useful thing? What can we really try to understand from him in this short amount of time to really help improve our investing knowledge? And there are 2 concepts in the Intelligent Investor book that Warren Buffett really cites as key, crucial concepts. And I think he said, if you understand these 2 things, as well as I think it was chapter 12 of John Maynard Keynes, then you're well on the road to being head and shoulders above many other investors in the market. And we're going to go through these 2 things right now. So we're going to go through Mr. Market first. Okay, so in order to explain this kind of concept, let's pretend we are looking at the prospects of a business. We're going to be looking at Wilbur's Whiskey, and we do our analysis and we value the company using value investing at $50 a share. So we've got our valuation. In comes Mr. Market, an impulsive businessman who offers high prices for stocks when he's in a good mood, low prices when he's in a bad mood. He has his emotions around all over the place, and they'll come knocking at your door with a different price to buy or sell your business every day. And he kind of represents the general market. So effectively, the whole idea is that Mr. Market is irrational, and the way that he changes his prices changes much quicker than anything that could significantly affect the fundamentals of the business, and hence the price that we value the business at. So week 1, Mr. Market comes knocking on our door, and he's going to offer us a price where we can either buy or sell shares of Wilbur's Whiskey. So he comes in and he says, today the price is $55. What are we going to do in this situation? We've got a company. We think it's worth $50. Mr. Market is coming in and offering us $55. We don't own the shares yet. We haven't had an opportunity to buy them. So what do? We just leave it alone. We just say, no, thank you. Come back knocking tomorrow, or in 10 minutes, or next week, wherever your investment time frame is, and he'll come back. He'll come back because the stock market is open 40 hours a week. And in fact, if you count all of the different stock exchanges all open around the world, it's open pretty much from Sunday night to Friday evening continuously. So he comes back on week 2. This time he's going to offer you a price of $40. Maybe he's in a bad mood. He's saying, I'll sell this business for $40 now. What are we going to do? We think the business is worth $50 a share. We'll go ahead and we'll buy it, right? So now we own the shares. Mr. Market comes back again. He's going to offer us another price. This time he says, right, I'm feeling slightly better. I'm going to offer you a price of $45. What will we do in this situation? Well, we already own the business at 40. We think it's worth 50. Do we want to sell it at 45? Probably not. So we'll just say, let's leave it here. A lot of people might say, well, you could buy more at 45 because you think the business is worth 50. That's true. I mean, I personally wouldn't necessarily do that. You kind of have to compare what the level of the price is offering you is with the price of the actual share. We're going to cover that in just a minute in the margin of safety slide. But yeah, you could buy more at $45 a share, but you have to be more careful the closer this price gets to your reflection of the true value. So let's hold it at $45. Let's see what he does next week. He comes back, he's jumping up with joy, and he says, look, I'll buy the business off you at $60. And you go, wham, bam, thank you, man. Here we go. Let's sell our business. And there we go. We've made a 50% return. We've kind of blocked out any of the market noise. We stuck to our fundamentals. We buy the business when it's cheap. We sell the business when it's expensive. And there you go. That's kind of how you make your money with value investing. Anybody got any questions?
Yeah, we did have a question from Max. So Max, if you're happy to turn on your mic.
Yeah. Can you hear me?
We can hear you, Max.
Yeah, you mentioned before that sometimes pessimism, when people are pessimistic about something, you should buy it because in reality it will go back to what it was before. But in some cases where companies rely on reputation, for example, an airline, where if there's a big airline, I mean, it hasn't happened. For example, if British Airways had a crash on one of their transatlantic flights, then that would obviously lower confidence in the airline, which would reflect people buying tickets, and therefore their stock would go down and it wouldn't be the best time to buy. So what would you say in that kind of case?
Yeah, absolutely. So what I would say is that you have to assess everything on a case-by-case basis. So when he was talking about buying from the pessimist and selling to the optimist, it's very much a rule of thumb. Like, yes, we see businesses that there's some negative news come out, which is detrimental to their company, and their share price falls, and in many cases they'll go bankrupt. In fact, I was messing around on one of my investment filters the other day, and I found stocks that I was basically trying to screen for the worst stocks, and those stocks that goes down like 10,000%. So what you have to consider, Max, is obviously that everything is on a case-by-case basis, right? So you have to kind of consider whether the reaction from the market has outweighed the pessimism from the stock. Like sometimes stocks go down with very good reason, right? Like a company has issued a profit warning. As you say, BA might have lost a flight and it significantly damages their reputation because people don't want to fly. You have to kind of weigh up how much of that is going to be damaging, how much of it is kind of reflected in the market being already like pessimistic. Is it something that's going to significantly kind of corrupt their business model and destroy it? Or is it kind of this temporary wave where the market is too pessimistic? And in fact, it's quite interesting because like this is actually where Benjamin Graham differs from Warren Buffett a little bit. Because so Benjamin Graham was more, he was like, buy the cigar butts, like buy the companies that are like deep in the dirt, the really bad companies that nobody wants, buy them incredibly cheaply. And then Warren Buffett is more about buying very, very high quality companies when they're cheap. I would definitely say that resonates with me a lot more. Does that answer your question?
Yeah, thank you.
Yeah, no worries. Yeah, it's basically like just a rule of thumb. Like, yeah, I'll never say just because there's been some pessimistic news, go ahead and buy a company, but just kind of weigh it up. Like particularly in my personal investing, like I've seen share prices get ridiculously low or ridiculously high on news when you actually like sit back and think about it is not that bad relative to the fundamentals of the company.
Like with Boohoo.
Potentially, yeah, exactly. Like you could see extreme optimism or extreme pessimism in that case. And you have to kind of weigh up rationally and quantitatively. And this is another benefit of value investing, how much whatever's going on is actually going to affect the fundamentals of the business. I can give you one example, actually. I was looking at GlaxoSmithKline, big pharmaceutical company, a couple of days ago. And the share price has declined a huge amount. And it's got a very high dividend. Investors were worried about a dividend being cut. The dividend is still kind of covered by the company's profits. They were worried about an increased competition, but it's a kind of situation where the business is still very, very fundamentally strong, but the share price is absolutely tanked. And those are the kind of opportunities where you think, right, the business is still growing. It's fundamentally strong. People are worried about a dividend cut. but really the company can still afford to pay out its dividends. Have the market just been overly pessimistic? People have kind of sold in a panic because they think their shares are going to go down. And once kind of all of that has died down, that's where you start thinking, look, let's go ahead and buy these shares because they're actually pretty cheap.
I have a quick question. I'm relatively new to all of this. This is in fact my first Zoom meeting, or whatever I'm joining.
Oh, welcome.
Thank you. And to put it in a very simple way, you want to buy shares when they're cheap and sell them for more at what you valued it at. Is that correct?
Exactly. That's
Okay.
exactly it.
Okay, so that's what you did here for this example. Wilbur's whiskey. You valued it at 50, bought it while it was cheap at 40, and you want to try and go as low as you can, ideally, and then sell for high as you can.
Exactly. Yeah.
Okay, cool. Okay, I've got that in my head now. Thank you so much.
Yeah, no problem. It's good to see new people here all the time.
Yeah, I'm really interesting. Thank you so much.
Yeah, no problem, mate.
Yeah, couple good questions there actually. Henry, do you have time for one more?
Of course, yeah, I've got plenty of time.
We've got one from Zach, but I'm going to leave it to a bit later if that's all right, because I think it's a bit more technical.
Okay.
But one from Ben, which is when Buffett bought Apple, was that value investing or growth investing?
Oh, that's a really good question. That is a really good question. Okay, so yeah, I think to be honest, it was a little bit of both. So in my opinion, given what I know about the situation, Buffett, what's been happening in the big stock market index recently is that the index has gone up because the big tech companies that make up a large part of the stock market, they have been going up very, very quickly. So some people might have heard of an acronym called FANG, that stands for Facebook, Amazon, Apple, Netflix, Google. Those share prices have done very well in the past 5 years. And that's pushed up the S&P 500 a lot, which is the main US stock market index, because the big companies were producing really high returns. This meant that people like Warren Buffett were kind of a bit closed out because he was investing in insurance companies, Coca-Cola, Big Pharma. They weren't really doing that well compared to the S&P 500 because the S&P 500 was being pushed up by these returns of these big companies. So did he buy it because it was a valuation play? Potentially there was some of it. I don't think he would completely ditch his valuation roots, but I think there was a big part of it who was like, right, I've kind of missed out on a lot of the big tech gains. It might be wise to have some tech in my portfolio. In my opinion, I don't think Apple is a stock where it's like worth 10 times the amount than what it should be. So I don't think it's like this pure like speculative play on it, but I do think that he went for more of a growth company. There was a little bit of bias because he knew that he kind of missed out on the big kind of FANG push earlier on in the kind of 2010 to 2017 period.
Yeah,
Cool.
Great answer. Great question.
Cool. Thanks for the questions, guys.
Yeah, really, really good. This is exactly what we want to see. So feel free to carry on, and if we get any more, then I'll let you know.
Cool, perfect. So, okay, the other thing I mentioned was the margin of safety. So this is kind of Warren Buffett's picture of where Benjamin Graham, you should really kind of pay attention to what he says in his book. So, okay, we've done our analysis and we value this company at $50 a share. If it's below $50, we want to buy it. If it's above $50, we'll consider selling. So if Mr. Market offered us a price of $49 tomorrow, would it necessarily be a good time to buy? This is what you've got to be thinking about. Obviously, in the last slide, I talked about what have we done here? We've gone forwards. Okay, I talked about in the last slide, however, it was at 45. I probably wouldn't rush to buy loads more. And there is a reason for this. You know, would it be a good price? Would it be a good deal if we bought something for $49 tomorrow that we thought would be worth 50? Technically, it's still a good deal, but it's not as good as if we thought it was worth 40. The reason why I would be hesitant to buy it at 49 and why Benjamin Graham would be hesitant to buy it at 49 is because of this concept of margin of safety. So effectively, the whole idea is valuing a company is difficult. What, for example, if our calculation was incorrect and the shares were worth $47, right? Like if our calculation was a little bit off and we thought they're worth $47, but we could go in and buy it, say $35, that's great, because there's such a room for error in our calculation. The term margin of safety is synonymous for the term room for error. Buying at 49, that only gives us a 2% margin of safety. So if our valuation is wrong, and it's very easy for valuations to be wrong, you know, they're not something that you can get exactly right a lot of the time, then that actually means we could be overpaying, right? Because it could actually be worth 47. And one quote that I like around this is that in investing, it's much better to be approximately right rather than precisely wrong. I think that's an incredible statement. If you take one thing away from this tonight, take that statement away. In investing, it's better to be approximately right rather than precisely wrong. And in fact, it'd be something that I'm going to talk about in future sessions, where if we look at kind of value investing models, my slight criticism for like the way that some financial professionals do it is they make it so complicated that like it's just almost like unrealistic. Like there's so many variables going into it that like one little slight error in the model, it just changes the whole thing. And eventually you just think, is there any point in doing it? Is there any point in building a super complicated valuation model that makes it get exactly right, when in the market you have thousands of companies, right? Like you only need to invest in 10 or 15 to have a greatly diversified portfolio, right? Like what if you just said, forget building super complicated valuation models, let's keep it all much more simple, and let's only buy the investments that are like trading at say 20 to 30% cheaper than what we think they're worth, right? Because then you have the margin of safety that if you're slightly wrong, it doesn't matter, because you're not likely to be 30, 40% wrong. But if you buy something that's only 2% undervalued and you're more than 2% wrong, then technically you're buying something that's overvalued, right? Have we got any questions, David? Cool.
No, sorry, I was on mute.
Yeah, no worries, mate.
I think we're all good.
I also wanted to kind of talk about the pros and cons of value investing, really kind of break it down, because to be honest, it's lost quite a lot of its momentum in the last 10 years. I think that a lot of people, they're not so loyal to value investing as they used to be. And I think you should be, right? Like at the end of the day, a business is a business. You're valuing it based off profits and cash flows of real earnings of that business. And you're buying it when it's cheap and selling it when it's expensive, right? Like the stock market, no matter how much technical analysis you do and growth and all those things would be great. And those things can make you money for sure. But bring it back to its roots. At the end of the day, you're buying a business, and you're buying that business because you are legally entitled to that company's profits and earnings, and you own a part of that business, right? That's what the stock market is all about. And this is why value investing is important, because you're trying to work out that business is cheap or expensive relative to what the market, or Mr. Market in his irrational exuberance, is currently asking you to pay for it. Okay, so this is the most important thing. So the greatest advantage value investing gives you, by far, in my opinion, is objectivity and rationality. So an incredibly key point, okay, I'll go into that in a minute. An incredibly key point for me here is, as humans, we're not computers. We're all exposed to behavioral biases. We're all exposed to emotion. Obviously, without emotion, life wouldn't be fun. And emotion is great because of what makes us human. But in the stock market, emotion is not good. You want to be emotionally detached. The great thing about value investing is it actually gives us a system to be emotionally detached. You know, rather than buying a company, it going up 5%, and then you trembling and getting all nervous, and you don't know whether I should sell and cash in my profit, or whether I should wait and it will go up more, and getting so caught up in all of that. Value investing provides a basic system to be objective and be rational. We think the shares are worth this. We'll buy it when it's cheaper. You know, in the best case scenario, more than 20% or 30% cheaper, and we will sell it when it's more expensive than what we think it's worth. It's as simple as that. So these are kind of, this diagram is very well known, but it gives you kind of an idea of the kind of emotions that control the stock market. So you've got shares going up, people get optimistic, they get excited, thrill, euphoria. This is how bubbles happen in the market. A lot of people might have heard of the term bubble. Is basically where you you see the actual price distorted far, far away from where the true value of anything is worth. Most famous example was the dot-com bubble in the US in 2000, where you had companies worth billions and billions that weren't even making revenue, let alone profit, revenue. The companies worth billions who didn't even have functioning websites. They were just billions off an idea. But basically what happens was when investors get anxious about what these businesses are actually worth, are they actually worth this much? The share price starts to go down. People start to deny it. They hold on to their shares. The share price goes down even more because people are starting to figure out these businesses aren't really worth that much. Then people get scared. They get desperate. Eventually what they'll do is they'll sell their shares. And when so many people sell the shares, right, the supply of the shares gets pushed out into the market. The share price collapses. The kind of valuations of the shares are more aligned with what these shares are actually worth. And then people will start realizing that again, and then we'll go back up the cycle, and the whole thing repeats. So I guess the key point here is that the market is dictated by emotions. That's why you see the stock market going up every day. That's why businesses go up and down loads all the time, when really there's not that much fundamental related to the business that's gone on. Like sometimes there'll be no major news on a company, and still you see the share price like fluctuate by 1-2% a day. It's crazy. So the point is, the less emotional attachment you have to your investment decisions, the more investment success you will have. And value investing gives you a framework to be objective and disciplined in your investment decisions. Do we have any questions? Where's the chat?
We do. We've got a great one from Katie, which is the 20% margin error that you recommended before for investments. Would you use that as a benchmark for both the long term and short term?
Yes, I would. If you're following the value investing framework, yes, I would. With regards to long term and short term, yeah. So just a side note, if you're like technical trading or trying to trade off some short term fundamental piece of news, it's a different ballgame. Like if you buy shares in Amazon, you think that Amazon's earnings results are tomorrow, you think they're going to do well, you put a price target on, I think they're going to go up 5%, and you sell the next day. That's a different story. If you're looking at value investing and margin of safety, I would say 20% is reasonable. I wouldn't want to invest less than that. But with regards to time horizon, short term and long term, yes, it works for both. Value investing is dubbed a long-term investment strategy. And in most cases, that's the case. Like usually it's the case because it takes a longer time for positions to work themselves out. But sometimes positions will work themselves out really, really quickly. Like you can buy a share at 20% discount to what you think it's worth. And lo and behold, next week, the market has realized the share is actually worth a bit more, and you can sell. You make 20% profit in a week. So yeah, I'd use it for long term and short term. Value investing is usually associated more with the long term, but it can be a short term investment strategy as well if the market like really quickly realizes the undervaluation opportunity that you've bought, and thus the shares go up to their true value.
Yeah, great. We do have another quick question from Hirsch, but it relates to Sharpe's ratio, which, as you've not covered yet, are we all right to leave that? And Hirsch, if you want to get in touch with Henry privately, or if you're going to cover it in a future session, we can hold that question for then. Is that all right?
Sure. Yeah, I can talk about it in a future session.
Yeah?
Yeah.
Perfect. All right.
Yeah. I can talk about it in a future session. I was just thinking because there might be something on the next slides that might relate to it.
Okay, well, look, the question is, when value investing, do you readjust your holding using Sharpe's ratio?
That's a good question. So not in the short term, but in the long term for sure. And if you're not using Sharpe's ratio directly, what you want to be effectively looking at is, I'm more look at just the pure beta, if I'm honest with you. Like rather than actually kind of calculating the Sharpe's ratio, what I would usually do is basically just look at the stock's beta, which is its implied volatility relative to the market, and think about what the stock could return if I'm buying at a discount to value, and what's the volatility of the stock. Like what is the probability that stock will go down significantly if the market goes down? Where's that volatility at? Yeah, and that allows you to effectively for low beta stocks, value them at higher rates or give you a lower discount rate, which values them higher. And the reason, the key reason for that for me is because if a stock goes down 50%, you're going to have to make back 100% in order for the stock to get back to where it was. If a stock is trading at 100 and it goes down to 50, you've lost 50%, but you're going to have to double your share to get back to 100. So that's terms called volatility drag. So with regards to Sharp, to be fair, it's not something that I've used that much. I do use it for analyzing funds a little bit more to kind of see where their risk-adjusted return is and whether the risk they're taking are justified. But in my own portfolio, I usually find that like looking at what my own discount rate is relative to the market and also what the beta of the stock is, usually gives me a rough idea of what I think the risk reward is going to be.
Good answer. Feel free to carry on with your slides and then questions after.
Cool. I also want to talk about short-term noise. So I'm sure a lot of people, they log onto their laptop in the morning and their desktop could look a little bit like this. And yeah, this happens, you know, if anyone's worked in kind of a big financial company, they might have given you 3 monitors. I think I had 5 monitors at Citi. So, and that's just like for all of the information you need at the same time. So it's a very information intensive job. With value investing, it allows you to be much more focused on the long-term fundamentals of the company rather than being overstimulated by the infinite amount of noise going on in the market. So reading and understanding the news, it's always very important as an investor, always. But with value investing, you don't have to be so much glued to CNBC 24/7. You know, it's much more about, is there anything fundamentally going on with my company? And does that mean that I need to change what I think the shares are actually valued at? And 9 times out of 10 or 9 days out of 10, there won't be anything, right? And this is why value investing is great for somebody who wants to kind of look at it long term, for it to not kind of take over their life. And you can kind of, you know, you can sit back, you can think, is there anything going on with my shares? Probably not. You know, as a value investor, I only kind of readjust my valuations maybe once a month max. So you have the earnings calls that come out once every 3 months, and then you've also got the kind of any kind of big news, like there's been a change in management where you might adjust your earnings, whether maybe there's been a big piece of news relative to the sector. But other than that, it allows you to not get caught up so much in the short-term noise of the market. I think we had a hand from Astel, if you want to go ahead and ask a question.
Oh, hello. Can you hear me?
Yeah, we can hear you, mate.
Oh yeah. Sorry, that was by mistake. Sorry, I pulled it down.
Yeah, no worries at all. But if anybody wants to do that in order to ask a question as well, just to kind of get my attention, then feel free. Right, so that's that. Here's one disadvantage, is that you will often not outperform the market, like the benchmark, the S&P, the index, whatever you want to call it, in extreme bull markets. This is what a lot of investors have struggled with in recent times, because we've had this really big bull market, particularly kind of post-COVID, and then skyrocketing all the way up. The market has gone insane relative to how the fundamentals of the companies in that market are improving. So when stock market prices are skyrocketing, obviously this means that stock prices are really, really high, and you often have to sit patiently and wait for more investments to sell at attractive prices. At the attractive prices, but you'd like to buy them. So you could have, you could have 10 whiskey companies. You want to buy them all at $50, but they're all trading at $80 in the market, and you often have to sit back and wait patiently. However, you do reap the rewards for this. You reap the rewards for this hugely. This gives you a lot of cash. So obviously, when you're not investing, you tend to have a lot of cash in your portfolio. And full disclosure, but I'm quite a big advocate of this, holding a lot of cash in your portfolio, because you're able to buy stock on the cheap when the market does crash. And this will lead you to outperform hugely when the market does crash. This is what Seth Klarman used to do. He was an incredibly successful investor. I believe, again, he was one of the richest investors in the world at one point. I think his net worth was above 5 billion for sure. So we're talking highly successful. And he would hold like 30-40% of his portfolio in cash. And what it allowed him to do, particularly in the extreme bull markets, what it allowed him to do is that when the market crashed, it allowed him to really just take full advantage of an opportunity. Not even when the market crashed, but like even if one sector crashed that he was particularly interested in, he could then go full horns. He had the cash to be able to do it. When all of the other players in the market were having to get out, he was able to get into the market. What happens to fund managers, and the reason why a lot of fund managers don't beat the index, or I should say one of the reasons, because there are many, is that they get cash thrown at them in times of optimism. So if we go back to this diagram here, in times of optimism, they get loads of money thrown at them, right? Investors are like, come invest my money, invest my money. So they have loads of cash when share prices are very expensive. The market crashes, everybody wants out. They've got to give their money back to investors. How are they going to do that? Well, they have to sell their stock to get the liquidity, to get their money back to investors. And then what happens right in the depths of the market, the bear market, when prices are incredibly cheap? Nobody wants to invest with these fund managers, and hence they don't really outperform because they can't take advantage of all these cheap prices. Seth Klarman, with his 30% cash, he's able to take advantage of the market very, very easily. Obviously, the caveat for that is that you often have to sit tight and be fearful when others are greedy, as Warren Buffett would say, in extreme bull markets. But you really do get to reap the benefits because you have the cash to be greedy when everybody else is scared. Share prices have crashed, and now share prices are cheap, and has offered you a lot of opportunities in the bear market. Got any questions? In the chat.
Yeah, the first one was actually from Sharif. When you say held in cash, is that the same as free funds?
What do you mean by free funds? I'm not aware of that term.
I assume the assumption is, let's say you've got 100 quid invested in your trading 212 portfolio, and you've got 30 quid just in the account sitting there. I'm assuming that's what you mean by the free fund.
Yeah, exactly. Yeah. So that's what I would do. I mean, sure, you could hold it in the bank, or you could hold it somewhere else. Somewhere liquid would be appropriate. And then, because it depends on your brokerage account, but like if you're transferring money, sometimes it might take a while to get into that account. So I'd say it's always worth holding it in the brokerage account. I wouldn't see a reason why not to. And sometimes the return on these brokerage accounts, like even if you're holding cash, they'll still pay you a return that's better than a savings account, just for like holding the money there. So I'd say, yeah, when I say hold cash, the way that I would do it is hold it in my brokerage account, just so then when anything happens, you're actually in full position to take advantage of the huge decline in the market.
Sure. We've just got another quick question from Elliot that I'm happy to take if that's all right.
Yeah, go ahead.
It's just, what's the difference between bullish and bearish for the new people? Bullish is just optimism, and bearish is pessimism in the market. So if you go back to March time when COVID kind of first struck and everything was shutting down, we had the lockdowns, bear market. Now, all the vaccine positive news in the bull market, and that is basically as simple as that. Bull positive, bear negative.
If a bull attacks you, it's got horns, right? So it will go up. It will like go up into you and it will attack you. So that's the up. And then when it's a bear, like bears are really huge, and they'll get you to the ground and they'll go down and they'll attack you. And then that's the bear market. So bull attacks you upwards and the bear attacks you downwards.
Cool. Yeah, that's it from the questions, I think.
Cool. We're nearly done, actually. What do we got next? Okay, so I'm just going to give a bit more context to kind of what is coming up. So Mr. Market, we go back to this example. We've done our analysis and we value the company at $50 a share. Here we go. So now that we have the strategy understood and the strategy in place, how do we actually go about valuing the company? I'm stuck. My mouse is stuck. Just give me a minute. There we go. How do we actually go about valuing the company? So there's two main methods of doing this. The first is, there we go. The first is absolute valuation, and the second is comparative valuation. So I'll go through these two differences now, but what we're going to do is we're really going to go into detail with these in subsequent sessions. So firstly, absolute valuation. That is basically where you try and come up with an intrinsic value of the company. I think the company's worth X. Exactly like we did with Wilbur's whiskey. So you can effectively build a valuation model This valuation model is called a discounted cash flow model. I'm going to go through exactly how we build this in subsequent sessions, but it's one of many different ways you can come up with an absolute valuation in the market. This one is from Square. So yeah, I put Square on here, which is looking expensive at the moment. And you basically just compare the value that you think Square is worth, i.e. in this case, $47, with the current market price. That's a little bit out of date. By the time I did it, it was $213. And then what your model says is that it's actually trading at a 78% premium. So we wouldn't want to go ahead and buy shares in Square when we think it's worth $47, but the Mr. Market is currently offering us $213. We'd really want to wait until Square got, from $40 or below, really, until we ended up buying the share. And this is very generous because this is a $47 valuation with 40% free cash flow growth over the next 5 years, which is incredibly generous. So that's what absolute valuation is. So this is discounted cash flow model. That's exactly what it's called. And with absolute valuation, you're coming up with an intrinsic value for the share in the company, much like we did with Wilbur's whiskey. In that case, we valued it at $50 a share. We bought it when it was cheap. We sold it when it was expensive. The other type of relative valuation, which I'm sure many more of you are familiar with, is effectively trying to use ratios, right? Trying to kind of use ratios. You can compare it across different companies, hence the term relative. And these basically look like a ratio is the share price of the company divided by some kind of accounting measure. So examples of these would be enterprise value to EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. Enterprise value to free cash flow, price to earnings, price to free cash flow, price to earnings growth. These are just examples. I'm going to go through them in full detail in the next session, but they're effectively comparing the price to some accounting measure. The most basic is probably the PE, which is price to earnings, comparing the price of a share compared to how much it's earning. So if I could buy a share for $100 and it was earning $8 per share in net profit, that's a bad example. That would give you price to earnings of 12.125. But if it was price of 100, earnings of 10, then that is effectively a price to earnings of 10. So you get the 100, you divide it by 10, and there you have a price to earnings ratio of 10. And yeah, you can basically make tables. So here's a table for one of the companies I was looking at. You can basically compare the price to earnings against what it's been like over the average, what it is compared to the sector, and what it is compared to the country as a whole. Obviously, what you would think is if the price to earnings ratio was lower, you're effectively getting more bang for your buck, right? If you have a price to earnings ratio of 8.4, it's meaning you only have to pay 8.4 times the amount of earnings in order to buy a share of that stock, right? Compared to 17.3. All else being equal, you'd rather own a business with a lower price to earnings, a lower price to cash flow, right? Dividend yields, that's not necessarily a relative valuation. That was just in this table. So all else being equal, you would want to own a business with a lower price to earnings ratio, right? But then you've also got to factor in what the growth is going to be of that business. If you had a business growing at 40% a year, obviously that's going to be much more value than a business growing at 5% a year if it had the same price to earnings, right? Because that business is going to grow much faster. Its earnings are going to grow much faster. And hence you're willing to pay a high price for that business because of its future prospects. And that's why you see tech companies have much higher price to earning ratios than say consumer companies in kind of food retailers, drug retailers, et cetera, et cetera. Do we have any questions, David?
I have another simple question, sorry.
Yeah.
What are dividends? I have no idea what those are.
Sure. Okay, good question. That's a good idea good time to explain this over. So a dividend is effectively a payment that the company pays you directly for basically being a shareholder, right? So as investors, we're legally shareholders of the business. And what a company will do is it will pay out some of its net profit to shareholders to just give them the profit, reward them for owning the shares. That's effectively what a dividend is. So you could buy a share at 40. You don't have to necessarily sell that to make money. Many of these companies pay dividends, and you can effectively make money by the company just paying you to own the dividends. It's very analogous to when you buy a house and you legally own the house, and then people kind of pay you rental income for kind of using that house. It's the same kind of thing. You buy the share for the income, and the income is distributed in dividends, which are a form of profit where the company will pay shareholders for owning that share. And then the dividend yield is basically just the dividend percentage over the price. So if I bought shares in this company, Altria, now, 8.3% of what I bought the company for, I would get paid in dividends every year. So if I invest $100 into that company, that means that Altria are going to pay me $8.30 in dividends every year. Does that answer your question, buddy?
Would it be 8.3 per share, per single share, or is it 8.3 of everything?
This is percentage. So this is the dividend yield is percentage, but then dividend per share would be in like per share terms.
Oh, okay. Thank you.
It's useful to compare the percentages because like companies have really different prices. Like some companies, like they're like priced, like Tesla is like priced for like $800 a share, right? There are many penny stocks that actually pay dividends that are priced for like $1 a share. And obviously, just to bring it all back to basics, the yield helps you compare it across different companies.
Okay, is there any like beginner reading material I could look into to get myself better on this kind of stuff?
I've just put a link. We have a society blog. It's a shameless plug here, but uobinvest.org, and everything that we write on there is aimed kind of for beginners. We have an investing 101 section, and it's got all this stuff covered. I've just put the link for our dividend article, but feel free to check it out, subscribe, and that should help you. I'd say that's a good starting point. And then Finimize is an app that I think there's either a free subscription or it's $25 for the year, but it is really, really good. You get a daily update on market news, and it's very, very basic. So they're the two kind of resources that I would recommend.
Finimize, did you say?
Yeah, Finimize. And then obviously you can go for Financial Times or The Economist, but they're a bit more complicated.
No, thank you so much. Thank you.
That's all right. Henry, time for one more question? Or
yeah, of course, mate. Yeah. We're pretty much at the end of the presentation.
All right, this one is from Max, and the question is, what are the benefits for a company if its share price is high or goes higher, other than, I guess, if the management owns shares? What's in it for the company when paying a dividend?
What's in it for the company when paying a dividend? Why should they pay a dividend?
Yeah.
So effectively, okay, this is a good question. So there are some companies that pay dividends and some companies that don't. There are many successful companies that pay dividends, such as Apple, right? Apple pays a dividend, but you have some of people who are very similar to Apple, like Facebook, who actually don't pay dividends. Microsoft pay dividends, Tesla don't pay dividends. So yeah, it's really just up to the management of the company, right? So what you've got to think about is that if you're a very high growth company, you want to be investing every single penny of profit you get back into the business to grow it, right? So if you're like growing the company at like 20-25% a year and your real growth, you don't want to waste any of that money paying out with dividends. You would rather it went back into the company, you grew the revenues and the profits of that company, and then you would reward the shareholders by the share price going up and then making money off capital gain. With regards to if you're a lower company, a more mature company, you're growing pretty slowly, so you don't have many places to really invest that cash other than to kind of maintain business operations, but you do have a lot of cash spare, then you would start to consider paying more out as a company, right? In fact, this company, Altria, I've been talking about it a fair amount. They actually pay 80% of their profit out as a dividend because they have a lot of cash. They're a very mature company, but they don't have that many new places to invest their company. They're a cigarette company, effectively. They sell Marlboro cigarettes in America. They can invest a little bit in buying shares in weed companies and e-cigarette companies, as they have done, but most of their cash is going to go out to dividends because they don't have that much innovation to kind of do with the business. Contrast that with a new tech startup, right? Palantir is a popular one at the moment, right? Like they want to be they don't pay a dividend, right? Every penny is going to go back into investing in the company because they know that every penny is going to be worth it because they want to grow at such a fast rate, and only later on they'll be thinking about dividends, like later down the line.
Good answer.
Yep.
We've got a couple more.
A lot of questions.
What happens when there's a stock split? Does a company's value change? Very simply.
Good question. This is a really good question because I think it's a very important point to cover. So why would a company have a stock split? If a company's stock got to say $1,000, it actually stops a lot of investors from buying it, right? Like if you run a $3,000 portfolio and the company's share is trading at $1,000, you'd have to put 33% of your money in to even get exposure to that company, which is not great, right? Like even if you're running a $10,000 portfolio and you didn't want to allocate 10% of your capital to that company, i.e. 10% being the $1,000 over $10,000, you couldn't do it. So this is why a company has a stock split. This is why it effectively makes the shares cheaper. They can do a stock split 2-to-1, so they can halve the share price. They can do a 5-to-1. I think Tesla did a 5-to-1 in 2020, right? I would think it was a 5-to-1 because their share price was really, really high. It was growing very high. And that allows small investors like us to get in without having to pay like $800 to own a small piece of Tesla. What happens then? A company doesn't change its value. Its market value or its market capitalization stays the same. What happens is the price per share halves and the number of shares double. So those things outweigh each other and the total market cap is the same. What will then happen is the earnings per share gets effectively changed because you've effectively doubled the number of shares, but then they will normalize that earnings figure to adjust for stock splits. So that will all stay the same. And everything fundamental about the business is still the same, right? Like the profit is still the same. The revenue is still the same. So that's effectively what a stock split is. It doesn't affect anything fundamental about the company. They just like halve the share price or they like pull the share price down by 5 times. So smaller investors can get in and then they increase the amount of number of shares to compensate that. So the market cap, which is just the number of shares times the share price, stays exactly the same.
Cool. Henry, just because we have less than a minute left of the hour, I'm going to leave the last couple of questions, and if you guys want them answered, then feel free to write them in our Alpha Room WhatsApp chat.
I'm happy to stay at the end. Can I just go on to my conclusion?
Yeah, just wrap it up, and then I'll wrap up, and then if anyone wants to stay around to ask their questions, they can.
I'm happy to stay on for a few minutes extra.
We still got to do that. We still got to do the book giveaway as well.
So. Oh, we do. The books are reminded on my next slide. Right, what have we got here? So yeah, I mean that's basically a conclusion of today's session. I know there's a lot that people want to know about value investing, but that is coming in subsequent sessions. So today we've been through what value investing is, how the strategy works, and we've introduced some different concepts to valuing a company, like looking at those ratios and starting to think about the types of models that we can use to value companies, right? So next week, we're going to put everything into practice. We're going to look at relative valuation, which is the price to earnings, price to free cash flow, comparing what a company is trading at compared to its competitors. And then we'll move on to the absolute valuation, which is what we did with Wilbur's Whiskey, saying, right, I think this company is worth $50 a share. I hope everyone really enjoyed that session. My name is Henry. You can add me on LinkedIn, WhatsApp, if you want to get in touch. This is my new YouTube channel. So on this kind of a YouTube channel, I basically publish content just like this, go through the financial markets. I do full stock analysis on specific stocks that I'm looking at. In fact, this week there's a full video coming out on an electric vehicle company that I think is going to be quite cheap. And that's going to be a very interesting video. I do personal finance as well. And there's also going to be an investing 101 course, full course, similar to how we've done with the Investment Society, just kind of helping to get people up to speed and really helping them break into their financial knowledge. So it helps them get into a career and helps them start on their investing journey. Please get in touch with me if you'd like a video on a specific subject. I'm very kind of happy to work with you guys and work out the content that you want. I'll be very happy to do that. And I've got content similar to what we discussed tonight. If you enjoyed that, you're very likely to enjoy what I've got on my channel. Please feel free to stay for questions. We're going to do the book summary now, but just again, I wanted to thank everybody for their attendance and well done to everyone who's made it so far on the investing journey. I appreciate it's a lot of work, understanding these concepts. So congratulations if you're still here. You guys are all doing very well, and are hoping that you're learning a lot through these sessions. I'm going to hand over to David now, but again, thank you guys, and yeah, we'll see you all next week.
Thank you, Henry. Brilliant session. If you enjoyed the session, just put a little thank you in the comments for Henry, because he puts a lot of work into all these sessions. And it'd be nice for him to feel appreciated, get some validation. Anyway, whilst Ethan is getting this ready, 2 very quick things. Once again, I've put the fundraiser links in the chat. Please go check out the website, sign up, learn a bit more. If you're happy to, please donate. It would mean the world to us. We really, really want to hit our target to raise money for the mental health charity Mind. And secondly, tomorrow night, we've got a huge event. It's a panel event with the UBS team. I think we've got 4, am I right, Ethan? 4 people from UBS coming to talk?
Yeah, potentially.
So we've got, from memory, we have, I've got it here. One second. We've got the head of multi-asset sales, someone from graduate recruitment that will be talking you through how to basically secure an internship or a grad scheme there, how everything's changed because of COVID, and basically the ins and outs of that. And I guess they'll just be talking about their different roles. Is it the head of technical trading as well? Yeah. So it's going to be unbelievable. It's a once in a lifetime opportunity to get to ask these people questions and to get to hear from them exclusively. They're putting on a session just for us, so make sure you're there. It's tomorrow, 7 p.m. Using the same Zoom link as tonight, and as always. And yeah, Ethan, spin the wheel and let's see who wins this book.
Sure.
Gotta get a dramatic drum roll. I think Joanna won last time as well. It's not rigged. But well done. We will get. Oh, she says, please spin again. That's really.
That's fair enough.
That is very nice of you, Joanna.
Thank you, Joanna.
Did you receive the Tower Trading, by the way? Has it come in the post? Elliot, congratulations. If you get in touch with me on WhatsApp or on Instagram, whatever, after this, we can get that book out to you. Well done. I hope you enjoy it.
Let David know which one you want. So
yeah.
you can have a summary, or you can have the full Monty and go for Benjamin Graham.
And also for anyone that wants to learn a little bit more about the intelligent investor, we have a book review on our blog, uobinvest.org as well, that you can check out. It was written by one of our students. So yeah, thank you all for joining us. Thank you again, Henry, and see you tomorrow night at 7 p.m. Anyone that wants to stick around for questions, please do. Anyone who wants to donate to our fundraiser or take part, please do. And go enjoy your Monday evening.